Okay, so thank you for coming today to today's SCORE Client Connect webinar on the ABCs of talking to a bank. And with us today, we have Rich Bidgood, a SCORE mentor, and Dan Beck from Community First Fund. I will let them introduce themselves, and then I will turn it over to them to drive the presentation. So Rich, do you want to start, and then Dan?
Yep. Thank you, Kathy. And if you can pull up the first slide, that would be great. In the meantime, I will just talk. I am Rich Bidgood. I am a SCORE mentor and a retired banker. Spent most of my career in lending to businesses. With me is Dan Beck, who is Vice President and Senior Lender of Community First Fund. Between the two of us, we have been in banking for 60 years. Well, more than 60 years, but we're not going to go into detail.
Stop counting at 30.
But yeah, but so we have talked with a lot of clients and potential clients and had a lot of conversations about lending. Our topic today is the ABCs of talking to a bank. We have also named it How to Make Your Business Plan Bankable, or How to Talk to a Banker. So there are lots of different titles. Maybe we couldn't decide among them, and so we put them all up there, but they all have a single focus. And if we can go to the second slide, it's this challenge. And the challenge is, as a business owner or founder, I need money to start or grow my business. Banks and other financial institutions lend money. And so the challenge is, how do I make the connection? And so whatever we call the seminar, this is the topic. And as Dan and I talk today, there are no hidden secrets. There are no insider code words or secret handshakes that if you can manage, the doors open. But as I said, between us, we've been in banking for 60 years. And so we hope we can give you some insights into the process of lending money and insights that you can use to give your own loan request or your own conversation with a banker its best chance for success. So to help you make a successful connection. And along the way, we hope we can take some of the mystery out of what these conversations are. So with that, let's turn to the agenda of what we would like to do today. I'll talk about what banks are and what they do, and give you a little insight into how a lender approaches the topic of lending money and makes that, in general, makes that decision, should I make this loan or shouldn't I make this loan? Along the way, we'll talk about the importance of a business plan and the financial projections. And then Dan will really zero in on taking that information and talking about what we can call the nitty-gritty, evaluating a request. We'll also then back up a little bit and talk about, we use banks generically, but there are other lenders besides banks, including CDFIs, and we'll tell you what CDFIs are. But each has their own nuance and has their own role and has their own suitability for various borrowers. And then ideally we'll have enough time at the end for questions and answers, but we'll try to roll through this and then give ourselves time at the end. So let's talk about lending money. It's a business. Banks and financial institutions are businesses. Some are not for profit, some are for profit, but they all have to generate money, and they generate money by lending money and getting it repaid with interest. It's as simple as that. And while from the outside, the money lending process is really complicated, it starts with questions, and it starts with questions about you, the owner, and questions about your business. And I think they are probably the same questions that you would have if I said, I need $10,000. would you lend me $10,000? And if I gave you 10 minutes and said, what would you want to know before you wrote me that check? I think the banker's questions are probably largely the questions that you would have. And so rather than take time, I have listed those questions, or at least most of them. And so we can go to the next slide. So what would a banker want to know? What would you want to know? I think these are probably the questions that you would write down. Maybe the words would be different. And if we interviewed a lot of bankers, their words would be different. But generally, this is the list that we would get. Is this a reasonable request? Does it make sense? If you asked me and I said, I really want money to buy real estate on the moon, you would say, we don't need to talk anymore. That doesn't make any sense at all. And so that's that. Bankers, of course, have to ask, is it legal? You might not think about asking that, but we have to ask that. You'd also want to know about me. If you're going to lend me money, do I have a good character? Am I trustworthy? Am I honest? Do you know that I've had loans in the past and I've repaid them? Or do you know that I've had loans in the past and I've never repaid them? That's pretty relevant. So you'd probably want to know that. You'd also want to know whether I have any money to put into this project that I'm asking for a loan for. That is to say, if I need $10,000, is the project that I'm going to use it for really $12,000 or $15,000? And I'm going to put some money into that. And that's important for a banker because it shows commitment on the part of the owner. And sometimes we call it skin in the game, but or money down. And that's fairly common in lending, and it's certainly common for banking. I think you probably want to know, if you're going to lend me money, do I have the strength to pay it back? Does the business have the strength to pay it back? Or is this just a gamble? Is the $10,000 something that absolutely is going to be put into a project that has to work, and if it doesn't work, there's no chance you're going to get paid back? Or is this to a business that already has some financial strength and can help pay back that loan? So how reliant is this loan on this particular project? Related question, does the business have just a sufficient amounts of cash that it can generate either historically or projected into the future to repay the loan on the terms agreed? Banks especially are very concerned, for legal and regulatory and other reasons, on loans being repaid on the terms that have been agreed, $100 a month for the next 20 years, whatever it is, that they are repaid exactly like that. So a bank is going to be very focused on whether the business can in fact generate that sort of revenue or income or cash, just as you would want to know. Am I able to repay you on whatever terms we agree on? And another question that both you and a bank might ask is, if this doesn't work out exactly as we planned, do you have other assets? Do you have other resources that you can bring to bear to help pay the bank back? Or to help pay you back? If I say, yeah, I have a savings account, or I have something that I could sell. If this doesn't work out, I can pay you back. So again, there are many variations of these questions, but they are the questions that are in a banker's mind. They're probably the questions that would be in your mind, again, if I asked if you would lend me $10,000. However they're worded and however they're listed, they lead to the one question that is in the banker's mind, and that's on the next slide. And it's the simple question, will I be repaid? A bank makes its money by being repaid, and a bank is in trouble if it can't be repaid. And so at the end of the day, that's what the question comes down to. Will I be repaid? And I'll tell you, the best banking discussions are those where the owner or the applicant comes in and understands that that's the question being discussed, that all these other questions are focused on that questions. And the best banking discussions are those where the owner says, I understand that those are the questions, and so I'm going to help you answer them in a positive way. I once had an owner of a business come in to talk to me about a loan. And when I started the questioning period, the questioning process, he said, it's none of your business. I'm here to borrow some money. It's none of your business what I use it for. And in some polite way, I had to say, I mean, we can talk about the weather, we can talk about the baseball game yesterday, but we can't talk about a loan because it is my business. In fact, that is the business we're in. And so that can't possibly be the answer. I have to understand what you are going to use it for, how you're going to repay me, and that I'm going to be repaid. So the best conversations are where that's a cooperative discussion, not a hostile discussion. And so the borrowers that would bring in a well thought out business plan and good financial projections that are realistic, let us sit down together and go through them to help me, the banker, be reassured, oh yes, I am going to be repaid. I see how that's going to happen. And there may be details to discuss along the way, but it is a path that we can both easily walk down where we both recognize that's the question being asked, and part of the job of the person coming in is to help me answer that. So hint number one, a really well thought out business plan and realistic projections are the very best way to start. So let's turn to the business plan. You've probably all seen business plans, and there are dozens and dozens of different versions of business plans, but they all have something in common, and they typically have these parts to them. It's an overview of what your business is. So a description, sometimes it's called the executive summary, but it says what your business does. It also has a good description of what it is that you're making or selling or providing. And that's often discussed in terms of solving a problem. There's some problem out there. My product or service is going to solve it. And most importantly, here's how it's going to solve it. A discussion of the target market. Who are the customers, or who will be the customers for a new business or product? A discussion of the competition. So really understanding the market by talking about the competition and how your product or service differentiates you, sets you apart, is going to make you successful. Occasionally, I would get people who would say, when we've talked about competition, oh, I don't have any competition. And again, it made me want to go back and either talk about the weather or yesterday's baseball game, because it told me they don't really understand business. Everybody has competition. Nonprofits have competition. The question is, do you understand your competition? And have you figured out a good way to find a niche in that competitive market and be successful? And I say everybody has competition because nobody has to buy your product or service. And so even if it's not a direct somebody selling something that is exactly what you sell, nobody has to buy your product or service. They can spend their money elsewhere. And so you do have competition. And businesses and business owners that didn't recognize that, I always felt as a banker, this may not be somebody who really is going to be very good at business. And so I'm not sure I'm going to get repaid. Which brings us to the management team. Management teams are a crucial part of the business plan, because at the end of the day, it's the management or the owner that's going to make a business work and be successful. And so as a banker, I want to know about the product and the service and the financial plan and all that stuff, but it all starts with the owner or the management team, if there's a team, having the relevant experience and showing that they understand how to make this business successful. The goals for the business are obviously important. So what's going to happen with this loan? How's it going to make you a different company or a different business or a different organization in a year or 3 years and 5 years. It shows how this is being thought out. And then finally, in my mind, the critical part of the business plan is the financial plan, where all of that beginning part of the plan is put into a financial plan that shows exactly how the money will be used, exactly how much is needed, and exactly how it's going to make the business more profitable. And that really is done in the style of balance sheet, income statement, spreadsheets, financial statements projected. I'll tell you again, there are dozens of different formats, and even if you get on the SCORE website, I think it shows many different formats. So there's no one preferred format, but they all tell this general story. And as a banker, and Dan may be the same way, but I would go to the overview of the business, that is the executive summary. Then I would go right to the financial plans at the end. And if I still felt that this was viable, I would then go back and read the words to fill in the details and to fill in all the nuances. But for me, I would go right to the financial plan. So again, just to reiterate the importance of the plan, it shows that the owner has the background and experience necessary to run the business successfully. And this may come in a variety of ways. If somebody comes into me and says, listen, I want to start a set design business. And I've been working for a company up in Lidditz doing that very thing, a large company for the past 25 years, and now I want to go out on my own. Well, that says to me, you know what you're doing already. We know we have some other things to talk about, but you know what you're doing. You bring that experience to the business. Or somebody who says, I want to open a barber shop, and I've been to barber school and I've apprenticed and so forth. That tells me that they understand the right way to run this business and have the skills necessary. Or just, I want to run a lawn mowing business, and I have done the appropriate background and studied my competition and so forth, but at least, so not everything requires further education and so forth. It also tells me, a business plan also tells me as the banker how well the owner understands their own business and how carefully they've planned. Even if I don't necessarily understand all of that, it shows me that they've done the research. And if it's well put together, that comes through. And that's really important because, again, that's part of the convincing me this is going to get repaid. And understanding their own business in detail. For instance, not just telling me about the world economy and so forth. I'm not interested in that per se, but I had a customer who wanted to open up a gas station in Lancaster, in town. And they talked a little bit about how much people drive and how Lancaster is becoming a tourist destination and all that stuff, which was important. But what they really did was study where the other gas stations were, where the one-way streets were that went past his location in the sense, and had done a traffic count. And then extrapolated from that into how many people would need to stop at his gas station on the way out of town. And so it was very specific, and maybe he was right, maybe he was wrong, but it clearly showed me that he understood what that business was going to do. By the way, he'd been in the gas station business, so he also brought that to it. But it reflected to me, oh, you've done the research. You understand what you're doing. And again, that all gets cashed out into the financial projections, which are conservative and realistic, not pie in the sky. And so, again, when people would have a conversation with me about their business, and they would say, here's why I think 100 people are going to stop in my store per day, because, and they would lay it out, and it would be realistic, well-founded, and reasonable, and they would understand it. So that's important. Again, it leads naturally to why am I going to be repaid? It does not need to be long. Let me emphasize that. It does not need to be long. It does need to be clear, succinct, and well-reasoned, and again, specific to your business. I've seen business plans that were terrific, that were 10 pages long, plus some financial statements. I've seen business plans that were terrible, that were 90 pages long, that talked about a lot of things. And at the end of them, I said, I have no idea if this person really understands this business. And so it was a lot of paper, but wasn't any help to me. So that's a little insight. One of the things I thought about calling this was what goes on inside a banker's head, but that seemed so scary. But these first few slides, I've tried to say what goes on inside a banker's head when thinking about a loan. And so now I'd like to get a little more specific and have Dan talk about a typical way a banker actually looks at financing request and maybe walk through some examples using this sort of general approach. This is the nitty-gritty part. So Dan, can I turn it over to you?
Yes, you can. Thanks, Rich. Yeah, this is the nitty-gritty, but this is the 5 C's of lending, as it says in the top, and this is the banking 101 basics, as I would call it, that these 5 key pieces are which credit decisions are made, and no matter what institution you work for, these are the things that are focused upon. And I would say some C's have a greater weight than other C's, and I'll try to point that out. But if you cover these 5 areas and you address these, you'll give the banker a much clearer picture as to evaluating the risk. But also, if you try to maybe perhaps mitigate some of the ones where you think you're the weakest, that will certainly improve your chances of getting a loan approved. I'm going to start with the first one, which is character. And basically, it's talking about your character and how you treat customers. And you can see it says the word credit history. Well, that's your credit score. A credit score is really a reflection about how you treat other creditors. So if you treat other creditors pretty bad, I'm unlikely going to do it because I don't want to be treated badly. And you may say, well, those people didn't work with me or whatever, but it's a reflection upon you, how you treat other creditors, and people you're applying to will certainly take that into consideration if they want to move forward with you. You know, if you're meeting with a bank and they say, how's your credit, be very truthful for them. Tell them the truth. If your credit is spotty, and say, well, it's okay, but I had some instances in it, and let them know. Explain it. You know, I had a rough period, and 3 years ago that I went through divorce. Divorces are usually very tough on credit and credit history, or I was unemployed and I didn't have medical coverage and I had a lot of medical collections. Explain your story if you do have not so great credit. But if you say I have good credit and it comes back you have bad credit, you kind of shot yourself in the foot because you really said that you're not trustworthy, and that's evaluation of character too. So be honest with them. They're going to look it up and they'll find out. What is a credit score? You know, what's a 675? What does that mean? It's an arbitrary number. These numbers that the 3 main credit scorers, TransUnion, Experian, etc., use, it's a formula that is proprietary. I don't know how they calculate it. No one does, unless you work there. And I'll tell you this much, they change the formula frequently without you even knowing it. So, you know, the best thing I'd say about that is don't so much worry about controlling your credit. just focus on what you can do, and that is to pay your bills on time. And if you run a situation where you're having difficulty meeting payments, don't just let it sit there and like, well, I'll get to it or whatever. Reach out to the creditor that you're having problems with, abilities to make payments on time, and negotiate some type of payment arrangement. Believe me, that the creditor will be impressed that you're reaching out. And if you do some type of credit arrangement where, well, I can't afford $50 a month, but how about $40 a month? It doesn't affect your credit. So, address the situations if you do have situations that are there. It's also, lenders have sometimes numbers in the I call it the sand. And a lot of it occurs to a lot of the larger financial institutions, national ones, where they're high volume loan. They have a lot of high volume of loan requests. They may have a number, and you may come in at a 724, and they may say to you, sorry, but you needed a 725. You were not qualified. So there are some institutions that have very strong parameters, and the person you're talking to doesn't quite have that capability of allowing to move the line back for you. And you'll find that sometimes if you have more challenged credit, some of the more community banks might be a little bit more lenient, but tell them your story, because if you're trying to make improvements on it, they'll keep that into consideration. So if you recognize that, no, I had that back a couple of years ago, but I've made these changes, now paying these bills on time, etc. I'm also going to say that, the worst thing that you can have on your credit is a charge off. And I have seen time after time after time of people that have charge offs for small dollars. I mean, $25, you didn't pay your copay, or $50 for your copay for your medical. Or if you remember back in time when people would cancel contracts with Verizon or AT&T, it was like a $275 break your contract. Well, I'm not paying that. Well, guess what? That's a charge off, and that's a huge ding to your credit. And it doesn't matter if it's $275 or $27,000. It's a charge off. So try to keep those charge offs off there, work out an arrangement and get it off the credit. That certainly will help. So credit does matter, and your history does matter. I'm going to move on to the second one, capacity. It's basically about your ability to make the payments, as Rich said earlier. Cash is king is the expression in banking, and your ability to repay them is number one. And how they measure that is going to be, they're going to look at your business and they're going to calculate the cash flow. And a real simple evaluation is they're going to take your net income after you paid everybody, yourself and everybody else. What's your net income? And then they're going to add back any kind of like non-cash expenses, which is basically depreciation. Depreciation is a tax shield. You do not write a check to depreciation, but it's a benefit you get on your taxes. So they're going to add back the depreciation, and they're going to add back the interest you may have deducted from it. So it's net income plus depreciation and interest, and that will come up to your cash flow. And then they'll calculate how much your debt service is. So they'll take your existing debt plus maybe any other debt that you have that you're maybe requesting. So if you're asking $100,000, they'll figure out what the payment is for $100,000, look at your other debt and add up all the debt service. And then they're going to divide the cash flow divided by the debt service. So they're going to divide those two numbers, and they want to see a ratio of 1.25. What does that mean? That means for every dollar of debt that you have $1.25 in income. They want to see a cushion of that capacity to debt of about 20 to 25%. If you're 1-to-1, you may say, oh, my cash flow, banks just say, not really, we need a little cushion. You're always going to be more conservative. So capacity is measuring that. And they also will look at you on a personal standpoint. They will say, what do you do on yourself? Do you have a lot of debt personally? Do you have to take out a large salary to meet your debt service, to live comfortably? They'll look at you personally too. So they're going to ask for your personal tax returns as well as a personal financial statement to measure how much you need to survive, because you are the company. Moving on to the third one, the collateral. That is probably the second most important one of all these, in that it is how, if cash flow is not there, which was the first one and the one I just talked about, the second one, capacity. If that's not there, then how do I get repaid? And that's liquidation of collateral. So collateral comes in a bunch of forms, typically real estate, equipment, accounts receivable, and vehicles. And banks will apply a certain percentage against those particular items because they're not going to get 100%. So for example, on real estate, if they have to go and foreclose on a home, they're going to incur a lot of costs to get that done. They're going to take you to court. It's going to cost for that. They've got to hire a realtor to sell it, and et cetera, et cetera. So they apply what they call advance rates on. So they're going to take real estate and they're going to put 80% value of the value advance rate on residential. So if you have a home worth 100,000 and you have no liens against it, the bank's going to look and say, well, it's $80,000 worth of collateral. However, if you have a personal residence and you have, let's say, $75,000 mortgage, they're going to, and you're looking for a $20,000 loan. The way they're going to calculate is they're going to take a $100,000 value, 80%. Now it's worth 80, and minus the 70. I think I said $75,000 lien against it. The value in terms of the bank is going to be a lot less. You know, we're looking at, like, what did I do there? $5,000 the value. So they're going to say it's not worth anything. Although in your opinion, you may say, well, I got at least 20,000. So they do take discounts and they apply that to also equipment. They're going to do 50 to 70% on equipment. Accounts receivable can vary greatly. It depends on the quality of those receivables and the ability of those people that you have receivables from and their ability to repay you. So that can go anywhere from 15, 20% to 70% or 75%. And then vehicles, they're going to look at the Kelley Blue Book value, which is basically what they can get if they sell it at an auction. So collateral is an important piece, but it's not going to be for what you paid for it or what you think. That's the way they're going to view it. Moving on to the next one, capital. Skin in the game, as Rich said earlier, is a big part. You got to have something at risk. No, we are in partners. I think Rich said earlier, we are partners, and that's how banks view it. We're in this together. So I want you to take some risk. If I give you 100% of the loan request, or 100% of the project amount, you can just walk away from it and lose nothing. So that skin in the game is typically going to depend on what you're doing. If you're looking at real estate, most conventional financing is going to be 20 to 25% of the purchase price plus closing costs. So generally, let's say you're looking at a $200,000 building, they're going to require 20%, let's say 20, that's $40,000. Oh, and also they're going to require the closing costs, which is probably going to be somewhere around $8,000. So you need $48,000 to be considered, and that equity has to be in form of true equity, meaning cash for somewhere else. Can't borrow on your home equity line of credit, that's considered debt. So that's cash in. So a lot of those numbers are pretty steep for most small businesses, 20 to 25%. There is an alternative product that you can do. It's called Sba Loans. They're loans which are the government provides a guarantee to banks of mostly 75% of the principal amount. So it entices banks to make those loans when there's a collateral shortfall. Sba loans typically require anywhere between 10 to 15%, substantially less in down payment and skin in the game. There are specific financial institutions that offer SBA loans. Not all banks do. You have to be an approved SBA lender. There are several. Community First Fund is an SBA lender. TD Bank is an SBA lender. Fulton Bank is an SBA lender. But there's other banks that are not. So, but that's another product out there. If you're short on that skin in the game part, could be a product that would make it help work. One last comment about capital is that small business grants don't exist. That's the bottom line. There are very, very, very few out there, small business grants. We get a lot of phone calls about people who want a grant, and it's just, they're just not there. They're only typically for the larger businesses that are making huge impact on the economy, local economy, and the most of that money comes from the state, and mostly state, quite frankly. Until I used to say that until COVID, then COVID hit. Now but COVID's done. That was a very unusual thing where there were grants out there to get people through, but they have stopped, and we're back to no grants. Finally, conditions, the last one there, that's basically general business climate. Is the industry almost, is it a cyclical industry? Are you in, for example, the restaurant industry? We're now going through inflationary periods, and prices are rising, and people's net paychecks are getting shorter, but they're bringing home because they got to spend more on food. And yes, it's going to affect the discretionary cash industry. So restaurants, hospitality, and travel will probably be going on a down cycle if we continue on these inflationary things. So those are things that we'll keep into consideration. As Rich said, also I look at the competition. What's the market? What's the economic? Are we in recession and expansion? And also off to a strength of management and also. So that's a quick breeze through of those 5, but the most important ones is the capacity, cash, and collateral, and the other ones are more subjective. So I'm gonna move on to the next slide.
Yeah.
It's basically, it's making these lending decisions. VCs are all integral as part of the business plan, really. As we talked about, the character so much, then that's an outside experience, but also this one puts character in terms of your experience, this particular presentation here. So yeah, I'm gonna look at your management in your resume. Do you have the experience to logically carry it forward? Do you have past work experiences that show that you have the ability and the cognitive ability to run this type of operation? I have had people call me and say, oh, I'm starting a restaurant up with my mom. My mom makes the best pancakes. Like, that's great, but you know, has mom ever served in a restaurant capacity? And has anybody done the purchasing for a restaurant or handled portion control was a big thing in restaurants and costing it? And no, she hasn't. You know, we're going to evaluate that part of it. The capacity part on there is going to be really driven by the projections and the projections you're going to provide or historical numbers. I'm going to calculate that net income, as I talked about, and determine, you know, how are you going to pay me back? And as I said, that's the key for that.
Dan, I just received word of a computer problem. And so we're going to be looking at this slide permanently.
Forever. Okay.
So why don't we jump ahead to, I think you've covered that. And so maybe the words of advice for preparing a business loan request, which has a slide, but we can easily walk our way through it if you want to handle that one, which is number 11.
I think that's where I was.
And maybe that's where you were. Okay, so let's move forward then in the interest of time. Let me do a quick little summary of all of this and talk about, Dan was starting to get into large banks and small banks and local banks. Let me do a quick little discussion about that, and then we can talk about that in a little more specificity. So while we say banks all the time, there are a lot of things that qualify as banks. I'm going to talk a little bit about commercial banks in a second, your standard Fulton, TD, and so forth, Wells Fargo. We'll have Dan talk a little bit about this specialty institution, community development, financial institutions. But other sources, before I get to that, credit unions are like banks. We've all heard of credit unions. They tend to be not-for-profit. They tend to have a little more flexibility, especially for early businesses, than perhaps some banks do. They're owned by their members. In fact, there's one called Members First, but they tend to be owned by their members. They can make some smaller loans, so that can be helpful as an alternative. Personal credit cards is another place where business owners come up with loans that they use. We tend to discourage that, but we know it happens. There is no business plan required. You can't always ask for a certain dollar amount, and the interests tend to be pretty high. So we know they get used. It's probably not the best spot, and they may not have enough, you may not get enough of a credit line to help out. Equipment leasing companies are non-banks, and they can be helpful, especially if you're looking at equipment, either from the manufacturer, let's say a copier, or from a dealer, lawnmowers or vehicles, or from leasing companies. They tend to be a little more aggressive than banks because they still own the truck or the lawnmower or the copier or the computer, whatever it is. They understand exactly how much those things are worth. So as Dan talked about, banks tend to take quite a discount on equipment because we're not good at selling them. Leasing companies are good at selling them, and they understand exactly what they're worth. And so they can be a little more favorable in that way. But they're very specific. You can't use an equipment leasing company to buy a piece of real estate. And then, of course, family. Don't rule out family as a source. For those who have families who are able to either lend money or contribute to a business, that can be helpful. They tend to be less strict. It depends on who your family members are. But you also have to remember that you may sit across from them at the dining room table at some point. So that's pluses and minuses. But there are other institutions that do lend money, and there's a brief summary of them. Let me talk about commercial banks for just a second, because that's what we're most familiar with. And it's good to keep in mind, and Dan mentioned this, they operate on a strictly business model. They make money by lending money. They also offer a wide variety of services, but they tend to be very conservative. And by nature, they take less risk they tend to take little risk, and they get paid for what they take. So the will I be repaid, they want to know to 99%, yes, I'm going to be repaid, and I'm going to get paid for that. And they're some of the smaller, how much flexibility they have depends on who they are. Some, from one end of the scale, they may do an automated scoring system. And as Dan says, if you come in at 724 and they need 725, it's the end of the discussion. Some of the smaller banks, perhaps the more local banks, may say, all right, well, let's talk about why you're there and not here, and let's work through that. So, but they tend to be on the conservative side. Some will offer SBA financing, but for new businesses or undercapitalized businesses, commercial banks can be a little more challenging, just because they aren't prepared to take on the amount of risk that they perceive in a new business. So keep that in mind. Dan, why don't you talk about community development financial institutions, one of which is in the logo behind you.
Yep.
As an alternative.
Yes. Thank you. Yes, they're called CDFIs, and it stands for Community Development Financial Institutions. That's a pretty big word. It's a designation from the United States Treasury. There's probably about 1,000, a little less than 1,000 CDFIs around the country, and they serve a purpose. And they try to. They're more of a mission-based lending, and the large majority of them are including ourselves for nonprofits. But what we try to do, for example, they're very mission-based, and the Community First Fund is really mission-based, is trying to get money out to people who typically don't have access to capital. For example, that would be people of color, women-owned businesses, people of low to moderate income, people that may live in low to moderate income areas or have businesses there. Could be nonprofits, because most nonprofits are going to serve that particular market. So it's very mission driven. We were purely just business lenders. There are other CDFIs around the country that focus on other missions. Some are very focused on low income housing. Some are focused on providing medical facilities to low income areas. Some are focused on just childhood education and daycare. So a variety, but kind of the stuff that commercial banks don't do and aren't designed to do. Commercial banks are regulated, CDFIs are not. So I'll call it the credit box that I play in is not as rigid as financial institutions are, because they have to maintain certain guidelines. Our guidelines are a little bit more blurred. We do have guidelines, but we do stretch things. We try to find creative solutions to situations and stretch as much as we can on our risk side to make that deal happen. So we're kind of like we find solutions to make people's dreams come true. There are some programs out there that also can be advantageous. As we mentioned before, a lot about SBA. That's one. There's also Sba Micro Loans. You can get Sba Micro Loans and we do Sba Micro Loans, and Assets and another CDFI does micro loans as little as $2,500. And even less. There's something called Affinity group lending, which is lending in groups. So the five of us right now in this call could receive $15,000, and we each have a small business, which we get $2,000, and we all lend the money as a group. And so if I don't make the payment for the month, you guys are responsible, and it's social pressure. So you would come to me and say, Dan, you need to make the payment. And it's another way of lending it's quite popular for smaller loans. And then there's a cohort like the five of us that share information amongst each other and talk about best practices. So that's another small type of lending. There's some other programs out there, but they're very, very specific to certain situations. So rather than going through a whole laundry list of stuff, a good banker will listen to what you're saying your project is, and then offer up those particular programs if it fits within those certain boxes.
Not all communities have CDFIs. We're fortunate in Lancaster to have a very active CDFI, which provides that nice alternative to some of those populations and some of those situations.
Yeah. Yeah.
Dan, in the interest of time,
Yep.
maybe we should say there's a range of where financing is available. We've talked about how a banker thinks through that. We've talked about how institutions approach the lending request from perhaps banks on the one end and CDFIs on the other, and the range in between. And so for next steps, if you think you need to borrow money for your business, I would say work with your mentor. We would both say work with your mentor, and Dan is very active with SCORE borrowers, SCORE clients. But work with your mentor, create a business plan that shows what your business is, exactly what it needs, and how it's going to repay them. So the business plan with the financial projections. Identify where would be the best home for that plan. Who would be most receptive to that plan? Where in that range of industries you would be most likely to find funding. Do the research, and you can even in some cases meet with a banker informally and just, here's what I'm thinking about. Here's kind of what I have. Does this sound like the sort of project that would work? It doesn't have to be the full-blown final presentation. That's a little, it depends on people on arranging that, but that's possible. And I would also say, when you put all that together, rehearse the presentation and the questioning period, the questioning process with your mentor. That's part of what your mentor can help do, is ask these questions and ask you to think through them and present them, so that when you are sitting in front of a bank or a banker, you've answered these questions before. You've had them asked, you've thought about them, and you have an answer that lets you put your best foot forward because you've rehearsed. Rehearsing always helps. So I would say those steps: work with your mentor, put together a plan, think about where you want to go, and rehearse and prepare. And it will make the banking discussion as comfortable as it can be, as comfortable as it's going to be, and will give you the best chance of success for your business. So with that, Dan, if you're okay, I'll say thank you very much for both of us. And if we have some time, if we want to stay around for discussion or questions, we're more than happy.